Hello everyone, this is Rene Ruiz with SoCal Purchase Loans, and I thank you for joining us for another educational series today. I'm talking about discount points and the break-even period that we like to present to you when we show you rate options that have discount points. The whole concept is do the math. Let's make sure that you're making the right decisions for yourselves when you consider whatever options you're choosing from. Now, the relevance is pretty clear. This is an affordability solution, and it is often misunderstood. I've had people ask me, well, where's the discount? These closing costs look higher. Well, discount points are basically a fee that you're going to be paying to get a lower interest rate on the home loan that you're going to obtain. And it actually means you're going to pay more in closing costs, not less. And last but not least, rates should be falling soon. It does kind of feel like they're starting to fall. And as they continue to, people are going to be looking in the rearview mirror thinking, should I have paid all those discount points? It looks like I could have got this rate for free or much cheaper now. So the definition from the Consumer Financial Protection Bureau says, generally, points and lender credit let you make trade-offs in how you pay for your mortgage and closing costs. Points, also known as discount points, lower your interest rate in exchange for paying a fee. Lender credit lowers your closing costs in exchange for accepting a higher interest rate, aka a higher monthly payment. Now, I've put together some examples. Please don't fear the math reaper. I've done all the math for you, but I want you to understand that there's math behind the recommendations that we make. And in the example that I'm showing you, it's $1 million purchase price with 20% down. You'll see that we have a recommended rate of 6.125 being compared to alternatives 1 and 2. In alternative 1, the interest rate is 6%. In alternative 2, the rate is 5.875. And as you look through my chart, and I realize it's a lot of information, so I've actually broken it up into 2 sections. You want to focus on the monthly savings versus recommendation when you're just looking at the monthly payments. And as you can see, the recommended rate has a 6.125 and a payment of $6,027.55. That's including our estimate for taxes and insurance. Whereas alternative 1 has a rate of 6% and a lower payment, $5,963.07. Alternative 2 has the lowest interest rate of 5.875 and the lowest payment at $5,898.97. You'll also see that my spreadsheet automatically calculates the difference in payments, and it'll basically take the payment on the recommended option, and when looking at alternative 1, it subtracts that payment, and it tells us what the difference is. It's $64.48. Same thing with alternative number 2. It takes the monthly payment for alternative 2, compares it to the recommended option, and tells us that the monthly savings are $128.58. So yeah, great, lower rate, lower payment. But in exchange for what? Well, it's in exchange for higher closing costs. These are in the same order. We've got the recommended option, that's the 6%. The net closing costs here are $3,500 because at that interest rate, we are getting a lender credit of 0.5 point from the bank, which is offsetting the closing costs. With alternative 1, there's nothing. There's no discount points or lender credit. You're just paying whatever your estimated fees are. But with alternative 2, you're actually paying discount points. You're going the other direction. You have $7,500 in regular estimated closing costs and then $4,000 in discount points. So the total amount you'll pay is $11,500. And if I can have you look all the way to the bottom of the chart, I want to point out that our spreadsheet automatically calculates a break-even period. Well, what that means is we will look at the difference in monthly payment between alternative 1 or alternative 2 and the recommended option, and we'll take the extra fees and divide by the monthly savings. That helps you figure out how long it's going to take just to break even on the extra fees that you're paying on alternative 1 or 2 compared with the recommended option. And as you can see, it's roughly 62 months, no matter whether you're looking at alternative 1 or 2. And that's pretty much over 5 years. And we anticipate rates falling within the next 6 to 12 months, and hopefully we'll be close to 5%, if not at 5% or lower by then. And the reality is, if you paid discount points, an extra $8,000 in my book for alternative 2 compared to alternative, the recommended option, well, you might kick yourself in the butt a little bit, because if we're right and the interest rates hit 5% within the next 6 months and we call you and say, hey, you want to refinance, you can get a 5% if you pay fees, or you can get a 5.25 and we'll pay the closing costs. Even if you're at 5.875, you're probably going to take the deal And because it hasn't been 5 years, you haven't even broken even on all those extra fees that you paid. So, things to remember. We will calculate the break-even period for you. It's actually baked into the way we present options when we're showing you discount points or options where we're comparing lender credit or par rates with discount points. Lender credit is the opposite of discount points. And if you don't qualify to refinance, or you know you won't qualify to refinance, that's when we'll actually recommend that you pay discount points. Like if I know you're going to be retiring in a year, and we don't know for sure that you're going to be able to refinance, well, that's when it might make sense to pay the discount points. Or if you're buying a home or taking out a home loan when rates are at historic lows like they were during COVID, it might make sense to pay points because you probably will never refinance that loan. And there will usually be refinance options that will have no closing costs. There's usually an option where the bank says, look, here's your 5% rate, but if you take a 5.25, I'm going to make an extra $70 a month. So I'm willing to pay the closing costs because I think that it'll pencil out over the life of the loan. And realistically, if we're in a position where we think the interest rates are going to go even lower, we're going to tell you to take the free option because it doesn't make sense to be paying closing costs each time you refinance. Also, and I actually forgot to list it here in the presentation, it's important for you to know that when you refinance, you're going to have several options to choose from. You may be able to take a 28-year loan or a 27-year loan. So a lot of people may be apprehensive, not wanting to restart the term of their loan over. Please know that there's solutions that we can offer to take care of that. Thank you for your time. Thank you for watching. And if you can think of any other topics that you'd like us to shoot videos on, please send us a note. We are happy to put the content together. In fact, we want to grow our YouTube channel and have as many videos on there as possible. Thank you for your time. This is Renee with SoCal Purchase Loans, and I hope you have a great day.